Preparing for a Kroger Financial Analyst interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Kroger? Kroger interests me because it combines essential consumer services with a highly analytical operating model. I would enjoy using financial data to improve pricing, inventory, labor, and capital decisions across a large store and digital network. The company's loyalty data also creates a strong connection between customer behavior and financial performance. My strengths in Excel, forecasting, variance analysis, and communicating recommendations would let me contribute while continuing to learn retail economics from experienced finance leaders. While answering, connect your interest in financial analysis with Kroger's grocery, pharmacy, digital, and loyalty businesses. Emphasize customer impact, operational scale, data-driven decisions, and your motivation to support profitable growth. Question 2. Walk me through the 3 financial statements and how they connect. The income statement shows revenue, expenses, and net income over a period. Net income flows into retained earnings on the balance sheet and begins the operating section of the cash flow statement. The balance sheet presents assets, liabilities, and equity at a point in time, while cash flow explains changes in cash through operations, investing, and financing. For example, depreciation lowers earnings without using cash, so it is added back in operating cash flow while reducing fixed assets. Make sure to cover the income statement, balance sheet, and cash flow statement. Explain net income, retained earnings, working capital, depreciation, capital expenditures, and the importance of reconciliation. Question 3. What are the most important financial metrics for a grocery retailer like Kroger? I would start with identical sales growth, separating price, volume, and mix to understand the real business trend. Gross margin shows merchandising profitability, while operating margin reflects labor, occupancy, shrink, and technology costs. I would also monitor sales per square foot, inventory turns, in-stock rates, digital sales growth, loyalty engagement, and free cash flow. Together, these metrics show whether Kroger is growing profitably, serving customers effectively, and converting earnings into cash. In your answer, discuss identical sales growth, volume and price, gross margin, operating margin, EBITDA, sales per square foot, inventory turns, shrink, labor productivity, digital growth, and free cash flow. Question 4. How would you analyze a monthly sales variance versus budget? I would first quantify the total variance and confirm that actual and budget periods are comparable. Then I would decompose sales into transactions, units per basket, average price, product mix, region, department, and calendar effects. I would compare results with prior year and operational indicators such as traffic, promotions, and digital orders. After identifying the root cause, I would update the forecast, explain the business implication, and recommend a specific corrective action. Be sure to mention establishing the baseline, decomposing price, volume, mix, geography, department, and timing effects, validating data, investigating root causes, and translating findings into a forecast or action. Question 5. What is identical sales growth, and why is it important at Kroger? Identical sales growth measures sales changes from comparable stores and channels, excluding distortions from newly opened, acquired, or closed locations. It helps management assess underlying demand and execution. I would still separate price inflation from unit or volume growth, because higher sales may not mean stronger customer demand. At Kroger, I would analyze identical sales alongside traffic, basket size, promotions, and digital activity to understand whether performance reflects sustainable customer engagement. Focus on sales from comparable stores and channels, exclusion of new or closed locations, effects of price and volume, and how the metric helps isolate underlying customer demand and operating performance. Question 6. How would inflation affect Kroger's income statement and financial analysis? Inflation can increase both procurement costs and retail prices, creating reported sales growth without equivalent volume growth. Gross margin may be pressured if cost increases reach stores before pricing adjusts, while labor, fuel, and occupancy expenses can also rise. Customers may trade down, changing mix and promotional needs. I would analyze units, price, margins, and basket behavior separately, then assess cash tied up in inventory and whether the forecast reflects nominal or real growth. Discuss supplier costs, retail prices, consumer trade down, gross margin timing, labor and fuel expenses, inventory valuation, working capital, and the need to distinguish nominal growth from real volume growth. Question 7. Explain gross margin and the factors that could cause it to change at Kroger. Gross margin is sales minus cost of goods sold, divided by sales. At Kroger, it can change because of pricing, promotions, product mix, private label penetration, supplier costs, pharmacy and fuel mix, shrink, and vendor funding. I would avoid treating a margin percentage as sufficient evidence. I would also examine gross profit dollars in units. A favorable margin rate may still produce lower profit if sales volume falls substantially or fixed operating costs remain high. Cover sales less cost of goods sold, product mix, pricing, promotions, procurement, private label, shrink, pharmacy mix, fuel, vendor funding, and timing differences between cost and retail price changes. Question 8. How would you build a sales forecast for a Kroger division? I would begin with historical sales by store, department, channel, and week, then identify seasonality and recurring patterns. The forecast would separately model transactions, average basket, pricing, promotions, digital orders, new stores, and closures. I would incorporate management assumptions and external factors such as inflation and local competition. Finally, I would create base, upside, and downside cases, compare the forecast with operational drivers, and establish a monthly variance review process. Mention historical trends, store base, identical sales, transactions, basket size, price assumptions, seasonality, promotions, digital demand, new stores, market conditions, and scenario-based sensitivity analysis. Question 9. What is working capital, and why does it matter for Kroger? Working capital generally includes operating current assets less operating current liabilities. For Kroger, inventory and accounts payable are especially important because groceries turn quickly and supplier payment terms can materially support cash flow. I would monitor inventory days, in-stock performance, spoilage, shrink, and payable days together rather than optimizing one metric in isolation. Reducing inventory may improve cash but damage availability, so the objective is an efficient cash conversion cycle that protects customer service. Explain receivables, inventory, payables, operating cash conversion, supplier terms, perishables, seasonality, and how efficient working capital management supports liquidity without harming product availability. Question 10. How would you evaluate an inventory variance or unexpected increase in inventory? I would first reconcile the reported balance to inventory records and determine whether the increase reflects units, cost inflation, timing, or a classification issue. Then I would review purchase orders, receipts, sales velocity, forecasts, markdowns, spoilage, and shrink by department and location. I would compare inventory days with targets and prior periods. If excess stock is confirmed, I would recommend targeted promotions, order adjustments, or transfers, while ensuring high-demand items remain available. Discuss reconciling physical and system records, separating volume, cost, and timing, reviewing ordering and receiving, identifying perishables and shrink, and recommending actions while protecting in-stock levels. Question 11. What is shrink, and how would you analyze its impact? Shrink is inventory loss that occurs through theft, damage, spoilage, administrative errors, or receiving discrepancies. It reduces gross profit and can create inaccurate replenishment signals. I would compare shrink rates by store, department, product category, and period, then investigate unusual changes against inventory counts and operational events. I would partner with operations to identify controls, such as improved receiving, freshness practices, or loss prevention, and measure whether actions improve both margin and in-stock performance. Include theft, damage, spoilage, administrative errors, and vendor discrepancies. Explain effects on gross margin and inventory accuracy, plus store-level trend analysis and operational controls. Question 12. How would you assess whether a promotion was financially successful? I would compare promoted performance with a realistic baseline, ideally using similar stores, products, or prior periods. The analysis should include incremental units, sales, gross profit dollars, vendor funding, discount cost, cannibalization, and post-promotion demand. A promotion can lower margin percentage yet increase total profit if volume is sufficiently incremental. I would also consider customer retention and basket effects, but I would separate genuine lift from purchases that simply shifted forward from another period. Focus on incremental sales, unit lift, gross profit dollars, promotional funding, cannibalization, customer acquisition, margin rate, post-promotion effects, and comparison with a credible baseline or control group. Question 13. How would you analyze a store remodel or new store investment? I would estimate incremental sales from traffic, conversion, basket size, and improved assortment, then translate those sales into gross profit and operating cash flow. I would include construction costs, equipment, disruption, labor, maintenance, cannibalization of nearby stores, and working capital. The investment would be evaluated using payback, NPV, and IRR under multiple scenarios. I would also consider strategic benefits, such as customer experience or digital fulfillment, while clearly separating them from quantified financial returns. Mention incremental sales, margin, labor and operating costs, capital spending, cannibalization, payback, NPV, IRR, scenario analysis, and qualitative customer or strategic benefits. Question 14. Explain free cash flow and why it matters to Kroger. Free cash flow is the cash generated by operations after necessary capital expenditures. I would begin with operating cash flow, which reflects earnings, non-cash items, and working capital, then subtract investments in stores, technology, distribution, and other assets. It matters because accounting profit does not fully capture reinvestment needs. Strong free cash flow gives Kroger flexibility to improve stores, reduce debt, return capital, or fund strategic initiatives without relying excessively on external financing. Cover cash from operations less capital expenditures, working capital effects, lease or interest considerations where relevant, and how free cash flow supports debt reduction, dividends, repurchases, and reinvestment. Question 15. What Excel tools would you use in a Kroger Financial Analyst role? I would use pivot tables to summarize sales and expense data, SumIfs and XLOOKUP to build reliable schedules, and charts to communicate trends and variances. For larger files, Power Query could standardize and refresh source data. I would use scenario inputs for assumptions, clear formatting for hard codes and formulas, and checks for totals, missing data, and balance integrity. My priority is not just speed, it is producing a transparent model another analyst can audit and update. Mention pivot tables, SumIfs, XLOOKUP or index match, conditional logic, charts, data validation, scenario analysis, Power Query, error checks, and model structure that supports reviewability. Question 16. Tell me about a time you found an error in financial data. In a monthly reporting project, I noticed one region's labor expense was unusually low despite stable staffing. I traced the variance to a file mapping error that excluded several locations from the reporting range. I reconciled the source files, confirmed the issue with the data owner, corrected the model, and quantified the impact before the report was distributed. I then added a location count check and variance flag, which made the process more reliable in later months. Use a concise star structure. Explain the control or analytical clue, validation steps, root cause, communication, correction, and process improvement that prevented recurrence. Question 17. How would you explain a complex financial finding to a store or operations leader? I would translate the financial result into an operational story. Instead of saying margin declined by 80 basis points, I might explain that higher produce spoilage and promotional mix reduced profit by a specific dollar amount across the district. I would use a simple visual, distinguish controllable from external factors, and recommend practical actions. I would invite the operator's perspective because frontline context often explains the data, then confirm ownership and timing for follow-up. Emphasize audience awareness, plain language, operational drivers, concise visuals, quantified impact, recommended actions, listening, and confirmation that the message is understood and practical. Question 18. Describe a time you had to manage competing deadlines. During a reporting cycle, I had a budget update due while completing an urgent profitability analysis. I ranked both tasks by decision impact and deadline, clarified expectations with each stakeholder, and created a short work plan with review checkpoints. I completed the time-sensitive analysis first, then reused validated data in the budget update. Both deliverables were submitted on time, and I communicated progress early whenever an assumption or dependency changed. Structure the response around prioritization, business impact, communication, time estimation, stakeholder alignment, quality controls, and a concrete outcome rather than simply describing being busy. Question 19. What would you do if a senior manager challenged your analysis? I would treat the challenge as an opportunity to improve the analysis rather than defend it automatically. I would ask which assumption or conclusion concerns the manager, then revisit the source data, formulas, period definitions, and operational context. If I found an error, I would acknowledge and correct it promptly. If the analysis remained sound, I would explain the evidence and sensitivity clearly, incorporating relevant feedback without changing conclusions merely to reach a preferred answer. Mention listening without defensiveness, revisiting assumptions and sources, separating facts from judgment, testing alternatives, acknowledging errors, and communicating a revised conclusion clearly. Question 20. How would you evaluate Kroger's performance against a competitor? I would compare metrics on a like-for-like basis, including identical sales, transaction growth, basket size, gross margin, operating margin, digital penetration, inventory turns, and free cash flow. I would also examine market share, pricing perception, store productivity, labor costs, and capital intensity. Before concluding that one retailer is outperforming, I would adjust for geography, fuel, pharmacy, accounting definitions, and acquisition effects. The goal is to identify durable operating advantages, not just headline differences. Discuss comparable sales, traffic, basket, margins, pricing, market share, digital penetration, store productivity, labor, capital intensity, and differences in accounting or geographic mix before drawing conclusions. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.